Welcome to this explainer. Today, we're basically stepping in as your personal CPA instructor to completely demystify the end of the accounting cycle. We're going to turn what usually feels like a massive chaotic jumble of numbers into a totally logical, seamless assembly line. So if you've ever been overwhelmed by period-end accounting, you are absolutely in the right place.
Okay, so let's jump right in. Think about the ultimate problem every single accountant or accounting student faces at the end of a period. Look, you've already done the heavy lifting, right? You know your debits from your credits, you've recorded the journal entries, posted to the ledger, and somehow survived adjusting entries. But now you're just staring at this massive list of adjusted balances. So how on earth do you turn that raw, messy data into the polished financial statements that real businesses actually use? Well, that's the exact puzzle we're solving right now.
Here's our roadmap for today. First, completing the accounting cycle. Second, the trial balance bridge. Third, the order of financial statements. Fourth, the accountant's scratchpad. And finally, temporary versus permanent accounts. All right, starting with part one, completing the accounting cycle, which is all about closing one period and getting ready for the next. Now, this right here is the exact four-step assembly line we're going to use to finish the job. Think of it as your ultimate mental map for month-end or year-end close. We start with step one, getting that adjusted trial balance. Next, we literally manufacture the financial statements. After that, we lock it all down with closing entries. And finally, we verify the whole shebang with a post-closing trial balance. It's a super systematic process. Moving right along to part two, the trial balance bridge, which is really your starting point. So after those adjusting entries are totally done, your adjusted trial balance acts as this master list. It contains all of your account balances. We're talking assets, liabilities, owner's capital, owner's drawings, revenues, and expenses. And, it goes without saying, but your total debits absolutely must equal your total credits here. Seriously, if they don't, stop right there. You literally cannot build a solid house on a broken foundation. I want you to imagine standing on one side of a massive river. Your adjusted trial balance? That's the bridge. It is not the final destination. I see so many people make this mistake. They think, awesome, the trial balance balances, I'm totally done. Actually, scratch that, it's just the launch pad. It's the bridge that carries your numbers over to the other side where the actual, formal reports live. This is just the staging area before the real construction begins. Think of crossing this bridge like sorting mail into very specific buckets. As you can see, the revenue and expense accounts just march straight off the bridge and right into the income statement bucket. Then your owner's capital and drawings accounts get routed directly to the owner's equity statement. And finally, your assets, liabilities, and that brand new ending capital you calculate just settle perfectly into the balance sheet. Everything has a very specific home. Which brings us to part three, the order of financial statements, or as I like to call it, the waterfall of numbers. Now that we've crossed the bridge and sorted out all our raw materials, we are officially on the manufacturing floor. But here's a super common trap learners fall into. Viewing these reports as just, totally disconnected documents that you can whip up in whatever random order you feel like. So we have to ask the big question. Why is the sequence of these statements absolutely rigid? Like, why can't we just start by building a balance sheet? Well, the answer is that one statement feeds directly into the next. It creates this precise three-step waterfall sequence. You absolutely 100% must start with the income statement. Then, and only then, you move to the owner's equity statement. And finally, you finish up with the balance sheet. If you try to skip a step or mix it up, well, the whole system just completely breaks down. Okay, let's dive into that first drop of the waterfall, calculating our net income. We pull our service revenue, which is $10,000, and we subtract our total expenses of $6,500. That leaves us with a net income of $3,500. And that specific number, that is the absolute key to unlocking the very next step. Now, watch how that exact $3,500 net income flows right down into the owner's equity statement pool. Just look at the logic here. We start with a beginning capital of $20,000. Then we add in that $3,500 of net income we literally just calculated, subtract the owner's drawings, which is $1,500, and boom, that leaves us with our ending capital of $22,000. The water has officially cascaded down into the second pool. And for the grand finale, that $22,000 ending capital drops right down into the balance sheet.
This ensures everything balances out perfectly. On the left side, we've got our assets sitting at $35,000. On the right side, our liabilities are $12,000, and we just plug in that brand new ending owner's equity of $22,000. 12,000 plus 22,000? Yep, that's exactly 35,000. Assets equal liabilities plus equity. Honestly, it is a beautiful thing when it all just clicks together like that.
All right, moving to part 4, the accountant's scratch pad, where we'll be navigating the worksheet.
So think of the worksheet as your behind-the-scenes scratch pad. Now, I want to be incredibly clear about this right out of the gate. A worksheet is not a formal journal, it's not a ledger, and it is certainly not a financial statement itself. It is simply a massively helpful planning board. It's kind of like a giant piece of grid paper where accountants map out all their moves before making them official.
When you visually organize your numbers into these 5 specific columns, drafting the final reports becomes an absolute breeze. You just start over on the left with your unadjusted trial balance. Then you pencil in your adjustments. You calculate your adjusted trial balance right there in the middle. And finally, you simply slide those numbers over into either the income statement columns or the balance sheet columns. It perfectly mimics that whole mail sorting process we talked about earlier on the bridge. But here's the crucial point, and you really want to avoid this trap. Just because you wrote an adjustment on the scratch pad does not mean the books are actually updated. This is literally the biggest pitfall for learners. They fill out this beautiful, perfect worksheet, everything balances, and they think, awesome, I'm done. No way. Your official ledger doesn't even know the worksheet exists. You still have to do the work to formally journalize and post those entries. And that brings us to our final section, part 5, temporary versus permanent accounts, also known as the cleanup crew.
Now, closing entries are going to seem super confusing unless you grasp one fundamental difference. There are accounts that live forever, and there are accounts that have to start completely fresh. Think about a sports scoreboard, right? The points scored in a specific game, which are like your revenues and expenses, well, those have to be reset to 0 before the next game can even begin. Those are your temporary accounts. But the actual stadium, the franchise value itself, your assets, liabilities, and capital, those continue to exist. Those are your permanent accounts.
These permanent accounts literally act as the foundation carrying your company's lasting financial health forward. We're talking about things like cash in the bank, equipment, outstanding bank loans, the owner's overall investment. These things don't just magically disappear into thin air at midnight on December 31st. They carry over. They are not closed out. They represent the actual reality of your business rolling right into the very next day. Which leaves us with one final, fascinating puzzle. If permanent accounts are what carry the business forward, why is resetting those temporary accounts to exactly 0 the ultimate secret to setting up a perfectly clean slate? Well, think about it. If you never clear the scoreboard, you'll literally never know if you're actually winning the next game. That's why mastering this cleanup process is absolutely crucial. Thanks so much for joining me on this explainer today. Keep analyzing, keep balancing, and as always, stay curious.